Hello student and welcome to this lesson. Today we are going to talk about the insurance principle. So insurance is essentially a contract by which one party gives a consideration, typically paid in money, for a promise from another party in order to make a return payment if certain loss has occurred. In order to start our lesson, we are going to see what is an insurance. Insurance is a contract or a legal agreement between two parties, which means that the individual named the insured and the insurance company called the insurer. In this agreement, the insurer promises to help with the losses of the insured on the happening contingency. The insured, on the other hand, pays a premium in return for the promise made by the insurer. The contract of insurance between an insurer and the insured is based on a certain principle. So let us know this principle in details. The first principle is utmost good faith. The fundamental principle is that both of the parties in the insurance contract should act in a good faith toward each other, which means that they must provide clear and concise information related to the terms and the condition of the contract. The insured should provide all the information related to the subject matter, and the insurer must give precise details regarding the contract. The second principle is the principle of proximate cause. This is also called the principle of the nearest cause. So, this principle applies when the loss is the result of two or more causes. The insurance company will find the nearest cause of the loss of the property. If the proximate cause is one of the which property is insured, then the company must pay a compensation. The following principle is the principle of injuriable interest. This principle says that the individual or the insured must have an injuriable interest in the subject matter, which means that the subject matter for which the individual enters the insurance contract must provide some financial gain in order to lead to financial losses if there any damage, destruction, or any loss. The following principle is the principle of indemnity. This principle says that the insurance is done only for the coverage of the loss. Hence, the insured should not make any profit from the insurance contract. So, in other words, the insured should be compensated to the amount equal to the actual loss and not amount exceeding this loss. The following one is the principle of contribution. It applies when the insured takes more than one insurance policy for the same subject matter. So the last one is the principle of loss minimization. This principle says that as an owner, it's an obligatory on the part of the insurer to take necessary steps in order to minimize the loss to the insured property. So the principle doesn't allow the owner to be irresponsible just because the subject matter is insured. Now we are going to see some types of the insurance. The first type is the life insurance. The insurance policy whereby the policyholder can ensure the financial freedom for their family member after death. It offers financial compensation in case of death or disability. So, life insurance can be classified into some major types, like term insurance. It gives life coverage for a specific time period. There is a whole life insurance. It offers life cover for the whole life of the individuals. There is an endowment policy. A portion of premium goes toward to the death benefit, while the remaining is invested by the insurer. There is a money-back policy. Here, a certain percentage of the sum assured is paid to the insured in the intervals throughout the term or survival benefits. There is a pension plan. It also called the retirement plan, are a fusion of insurance and investments. A portion here from the premium is directed toward the retirement corpus. There is a child plan. It provides a financial aid for children, and for a policyholder throughout their lives. The second type is the general insurance. Everything apart from the life can be insured under a general insurance because it offers financial compensation on any loss other than a death. So it covers the loss or damage caused to all assets and the liabilities. The insurance company promises to pay the insured sum to cover the loss related to vehicle, medical treatment, the fire, to the theft, even for financial problems during a travel. So it can cover almost anything and everything, but the 5 key types of insurance available under it are a health insurance, which covers the cost of a medical care. There is a fire insurance, which gives a coverage for the damage caused to goods or property due to fire. There is a travel insurance, so it compensates the financial liability arising out of non-medical or medical emergencies during travel within the country or within an abroad country. There is a motor insurance. It offers financial protection to a motor vehicle from a damage due to accident, fire, theft, or a natural catastrophe or a natural disasters. A home insurance. It compensates damage caused to home due to man-made disasters, to a natural disaster, or to other threats. In order to end our lesson, we are going to see the benefit of insurance. The insurance gives a benefit to individuals and to organizations in many ways. Some of this benefit is discussed below. The obvious benefit of insurance is the payment of the losses. It's managed cash flow when paying capacity at the time of the losses. Also, it complies with the legal requirement by meeting a contractual and some of the requirements. Also, it provides evidence of financial resource. It promotes risk control activity. Also, it program of losing control of because the policy requirements. So the efficient use of the insured resources, it provides a source of investment funds. Also, it collects the premium and invest those in a variety of investment vehicles. So this was our lesson of today. See you in the coming lesson.